Hello, and thank you to all of our attendees for joining today's Family Office Network's webinar series. Presenting for us is Larry Hilsheimer, Executive Vice President and Chief Financial Officer of Greif. Larry joined Greif in May 2014 as CFO. Previously, he has served as Executive Vice President and CFO of Scott's Miracle-Gro, Executive Vice President and CFO of Nationwide Mutual Insurance Company, and Vice Chairman and Regional Managing Partner of Deloitte. Larry holds a bachelor's degree in accounting from the Fisher College of Business at The Ohio State University and a law degree from Capital University Law School. Larry is joining us today to discuss Greif and how they are pursuing its vision to become the world's best performing customer service company in industrial packaging. At the end of today's presentation, we will have plenty of time for Q&A, and we always encourage your questions. Please use your questions chat option on the right side of your screen to submit all questions over so we can answer them accordingly. And with that said, Larry, I'm going to let you get started.
Great. Thank you, Lindsay. And thank all of you for joining us today. We very much appreciate and value the opportunity to talk about Greif with you. With me today is Matt Eichmann, who's head of investor relations and external communication, as well as sustainability for Greif. So this opportunity we find is quite unique to be able to talk with folks with the Family Office Network. A little bit of background of why this was potentially interesting to me is that during my time at Deloitte, one of the things that I actually did was worked on estate planning, income tax planning, and financial planning with a number of family offices and more well-to-do individuals. So it struck me in thinking about things that Greif has a very compelling value proposition for at least what I experienced in working with a number of family offices. And so we thought it worthwhile to explore that view and share our story about Greif. Greif is a company that's been in existence since 1877. It's been a public company since about a century ago in the mid-1920s. It has a significant family ownership. We have a dual-class stock system with B shares and A shares. The B shares are voting, and a family, which has been in the business since the 1940s, has over 80% of the voting stock. There's also non-voting stock. And the equity ownership of that family is quite substantial. It's not like you would see in some tech startups where the equity, the voting control is held by somebody with a small equity ownership. The family's view is they would like this company to continue for multiple generations, and that the primary thing is make sure it keeps growing and make sure we pay the dividend. So we have a very nice dividend yield, and the family also has a rule that none of the family members can be employed in the company. We do have a couple of family members on our board of directors, although I would say to you, if you came in and watched, you wouldn't know which ones they were without a scorecard. So the company's been in industrial packaging its entire existence. We actually started as a wooden barrel manufacturer. But we are roughly $4.5 billion of revenue. In our fiscal 20, we had $642 million of EBITDA, and we have multiple segments. Matt, have you go to what our primary operations are. We make steel drums, fiber drums, plastic drums. Then we also have closures that we make for those, and we also sell those to our primary competitors. We also have rigid industrial bulk containers, which you'll see on the lower right of page 5 of the deck. And we also then have in our paper business, we make the stuff that becomes cardboard boxes, and we also make the stuff that becomes tubes and cores. So obviously tubes are things you put things in, cores are things you wrap things around. So think of things as diverse as plastic wrap that you might use in your household or toilet paper, all the way up to heavy industrial cores that would be used to roll things like carpet on, or actually the things that, as you see on the left hand of that slide, big rolls of paper have cores inside of them. So those are the products we make. We are the #1 steel drum maker in the world. We're in over 40 countries around the world, have over 100 plants making steel, fiber, or plastic drums. We are also the #1 producer of fiber drums, and we're the #2 producer of plastic and the #3 of IBCs. In our paper business, we are the #2 producer of tubes and cores. That's a domestic only business. We're not international in our paper businesses. I'm going to go to the next slide, Matt. And I covered this previously, but we also have depicted on this slide the annual dividend that we pay. We are a relatively high yield dividend paying company, very important to our shareholders, and something that obviously mitigates any kind of downside risk. And the dividend is extremely secure. The top owners we've laid out there, and on the right you see the Dempsey family and descendants. So primary things for us and what we really focus on, as we talked about, our vision is to be the best in customer service in this industry worldwide. We have had that focus since the time that Pete Watson and I took over leadership of the business. It's something that Pete and I believe passionately, is that you win by providing the best service along with outstanding product. We also believe passionately that you do that only if you have engaged teams. And so we work a lot on having highly engaged colleagues. We measure it using the Gallup tool around associate engagement. And we have improved our engagement rapidly over the last 5 years and are now in the top decile of companies in engagement scores within Gallup. In customer service, we measure two criteria. One is an internal measure on customer service index, and our objective is to have our businesses performing at a level of 95% or above. We're not quite there yet, but we will be, and we are in many of our businesses and many of our operations. And there are a number of factors that go into that: on-time deliveries, complaints, those types of things. We then buttress that with a Net Promoter Score, which is an external survey by a third party. We've been now utilizing that for a number of years. When we first started, we were in the low 30s. World class in industrial manufacturing is the mid 50s, and we're now achieving consistently well above those. And our objective is to get even much better. If you look on the right side, obviously the other thing that we hold ourselves accountable for is to continuously improve our financial performance. While a little bit challenged through the pandemic, and we had a very weak for us third quarter last year, and we are a 10/31 year-end company, by the way. We still produced adjusted cash flow last year at a record level for us of $346 million by very consciously managing working capital and producing relatively solid operating results through the pandemic. We also have a major focus on sustainability. As I mentioned, Matt oversees that, and we consistently receive recognition by some of the notable award related agencies around the world. How we operate, I focused a little bit on this already, but you'll see our purpose, which really played through during the pandemic, about, to safely package and protect our customers' goods and materials to serve the essential needs of communities around the world. I don't think we could have worded that any better than what we had last year. We were deemed essential everywhere in the world because we ship things that people need. We provide the packaging that ships things that people need. I talked about our vision and our focus on having engaged teams. We have a major focus on healthy. Our view is that it's our obligation to make sure that our colleagues return home safely every day. and we have dramatically improved safety over the last 15 years since there was a true focus on it, and we are world class in that area as well. We base everything on a business system, which is really, when you get down to it, it's about lean manufacturing and operating in a highly efficient and effective manner. We run that through a centralized monitoring system, but it's deployed obviously at each and every plant around the world. And then everything comes on our values, which are fundamental and really get to treating people the way that you'd like to be treated, and operating with a high degree of integrity in everything we do. So, as I mentioned, we've been very focused on driving our improvement in our overall Net Promoter Score and Customer Service Index. You'll see in wave one, I actually thought, Matt, I thought it was 32 at the beginning. I was wrong. It was 40. But we've driven nice improvement over that time. And you'll see, if you pay attention to us, this is mentioned in every one of our earnings releases. Where do we stand? What's the progress we're making? And we've been able to demonstrate in measuring this by plant around the world that the better we're doing on customer service, the better profitability we exhibit in the plants. Next page, Matt. So, enhanced financial performance. One of the things that existed when Pete and I were fortunate enough to become leaders of the enterprise is that the company had in our global industrial products business, which is the steel drums, plastic drums, fiber drums, and rigid industrial bulk containers, a maniacal focus on market share and having the largest business, being number one in the markets. Pete and I have a different view, which is that we need to be paid for what we do at profit levels that make sense. And so, in the time since we've been in our roles, we've shuttered or disposed of facilities that were responsible for $450 million of revenue. We had looked, is there any way to get them to levels of profitability that would be acceptable, and concluded no. And so we walked away from the $9 million or so of EBITDA that was related to those plants. Obviously, a 2% EBITDA margin is not an acceptable level of profitability. We've been able to replace all that revenue with higher margin business, and our margin has consistently been improving over that time. As well, by having less plants, we then were able to drive savings in terms of what we need to spend every year on maintenance capital. You'll see later that one of our highest priorities make sure that we spend the appropriate amount of capital to protect the cash machine that works quite well. Last year, as we mentioned, despite lost revenue, we still increased our EBITDA by 300 basis points over those time frames in terms of our margin percentages, and we continued to drive improvements in margins through the pandemic last year. Although, to be clear, our profitability was below what we expected it to be going into the year, which I don't think would be a major surprise to anyone. On the next one, one of our highest priorities is to make sure that we always generate cash flow. It's my belief that this business, well run, is a cash machine. We produce a product that is very needed. If we run the business well, manage our cost structure, and produce good product with excellent service, we should be able to produce a lot of cash, and we do. And you'll see that trend has continued to go up, and we have commitments on the streets of what we'll deliver in fiscal 22 of cash flows between $410 and $450 million. That presumes that the economy comes back, and in 22 is equivalent to where it was in 18, which preceded the industrial recession that was before the pandemic. And right now, at least our view is, with the mountain of stimulus pounded into the economy, the likelihood of that is pretty high. So then if I look then into our focus on sustainability, we've got a lot of efforts going on and have had for a long time. Greif started publishing sustainability reports much before it became normal practice. Part of that was our global footprint, where it is obviously something that is looked at more, what's more expected in other areas of the world before it has become more important here in the U.S. But we continue to look through how do we become better stewards of our environment while still taking on efforts that will improve our operations. In the social aspect, we have first-class operations around the world. We respect our people and treat them well and do the right thing is what we always work to do. And from a governance standpoint, we work very diligently to make sure that we do not have any environmental issues, safety issues, those kind of things, have all the ethics programs, et cetera, that you would expect us to have in place. And I already mentioned a lot of the awards that are mentioned on slide 15, so I won't repeat that. But let me then move into, we believe there are a lot of reasons that would support you considering an investment or making an investment in Greif. A lot of the trends of emerging economies, our footprint around the world and our reputation in our industry is very, it puts us in a good place for all of those expansions. We tend to be, or we are in forms of packaging that are essentially all wholly recyclable. So, plastics have a bad name, but that's mostly single-use consumer packaging. Our plastic drums, our IBCs, and those can all be recycled. The plastic can be reground and reused. The same thing with our steel drums, and our paper packaging business is very environmentally friendly. And that business is seeing expansion, the paper business, as more and more forms of packaging are looking to move from consumer plastic packaging into more environmentally friendly forms like paper in the consumer space. Also, we have had a long focus on transporting food safely. We have a lot of facilities worldwide that are rated appropriately to be able to serve those markets. We spoke about our focus on driving cash flow. We've also continuously looked at improving our operations over time. And at various times since Pete and I were fortunate to be put in place of leadership here, we've laid out commitments. In 2015, we laid out commitments for 17. We hit those and exceeded them. In 17, we laid them out for 20, and we did the same. And now we laid out further ones in 22, and we anticipate and expect that we will also deliver on these commitments. The cash flow puts us in very good shape to accomplish another objective that I'll talk about on the next slide. So we did do an acquisition a couple of years ago of another large packaging company. It was called Caraustar. It put us in the tube and core business and also the coated recycled board business, which is basically a product that's used in box products for, like, if you went to a department store and bought some shirts or something, they'd package it up in a box that's a CRB product. Same thing with cereal boxes and those kind of things. So, but the primary business we bought is the tube and core business. To do so, we levered up to a level that was significantly above our target leverage ratio, which is 2 to 2.5 times. And our commitment at that point was to make certain that we continue to pay down debt, pay down debt, and pay down debt until we get back in our leverage ratio. But primary to our commitments on capital is that we will always pay our dividend. And our objective over time is to get to a consistently increasing dividend on a regular basis, which is not something that has been done throughout Greif's history, but is our commitment as we get back down to 2.5 times, which Matt will go to the next slide and show our path thus far. So we did the acquisition in Q2 of 19, and you'll see, obviously, we're making great strides on reducing our debt, and the impact of the pandemic produced a depression on EBITDA last year, somewhere north of 100 to 120 million. Obviously, in the ratio calculation, that has a negative impact as well. But with the pay down of debt, because we keep producing cash, and the return of our EBITDA levels tied to the commitments that we just spelled out, we will be down to our target debt ratio by the end of 22. At that time, we will be looking to continue our growth through, if there are suitable acquisitions, to go further into plastic packaging, especially rigid industrial bulk containers, perhaps expand our geographic footprint. But if we do not, then we will be returning even more capital to our shareholders, because we don't think it's efficient for us to get our debt ratio down below the 2 to 2.5 time range. So I ran through things relatively quickly. I'll finish with this and then move to any Q&A, which we'd love to answer any questions you might have. We think we have a very strong portfolio of products where we have market leadership share in virtually every major market in the world. We believe that we've created extremely sticky customer relationships because of the outstanding customer service we provide. And we have, while they're low growth businesses, they are also low risk, and we have the opportunity to continue to expand our margin. We believe that over the next year and a half, we will expand our margin in the global industrial products business by another 200 basis points. And we focus on driving cash flow, returning capital to shareholders, and being wise with our deployment of capital into expansion projects and acquisitions. We're also very committed to sustainability in all of its elements, from treating our people appropriately to treating the environment appropriately, and of course, treating our shareholders appropriately. So with that, let us turn to see if you have any questions that either Matt or I might be able to address. And thank you for your time.
Larry, thanks so much. Yes, to our attendees, moving into Q&A. Again, we encourage questions. That's why we have everyone here in live. So using your questions chat option to submit those on over. I'm just going to dive right into it here, Larry. I hope that's okay.
Sure.
First, what's the best way to track or anticipate your performance? And are there particular market indicators that you watch?
It's a very good question. It's things that we, when I first came to Greif, I was looking for what are the best leading indicators, and they had a lot of time spent. I actually engaged some folks from Ohio State University to try to figure it out. There are no real, like specific linear things to follow. We are basically a GDP industrial production kind of company. So if you think GDP is going to be growing, that's a good thing for us. Industrial production is a better one, but harder to get an advanced read on.
Sounds great. Thank you. Next question. How does culture factor into Greif's business plan and strategy?
Yeah, we, when I arrived at Greif, somebody told me that that the colleagues around the world really truly valued the Greif way and what it means and how it goes to how we treat our colleagues, and that if you wanted to change directions on a path at Greif, it was pretty easy to do because there was trust throughout the organization because of how people are treated. And I would say that's played out to be very true. We rapidly changed the objective of the company from being one focused on market share and growth and just gaining customer relationships to one focused on getting what we called value over volume, where we're getting paid for the value we deliver and shifting to customer service. So culture is a major component. And there is this sort of family element to it. The Dempsey family, while they're not at all intrusive in anything we do by any measure at all, what they do like is the fact that we have a culture where we treat our people with respect.
That's fantastic. Sounds like a great place. Now, Larry, your cash flow has grown impressively over the last several years. What are the key drivers to that improvement?
Yeah, what it's really been is getting out of some poor performing operations that we had. The company had made a number of ill-informed acquisitions in the prior decade. Made a couple of really good ones at the late part of the turn of the century and also in the beginning of the century, but then made some ones that were not very effective and were potential cash issues. And the company was not consistent in managing working capital. You had a lot of heroics that would go on at the end of one year, and maybe somebody had an incentive goal on cash flow. What we've been trying to do is make sure that everybody understands that we focus on cash flow and management of working capital consistently throughout the year. And actually, one of our incentives that applies for the top, couple hundred people in our company in our short-term plan is on trailing 12 months average working capital. So the focus can't be at the end of the year; it's got to be throughout the year. And we did that on purpose, and it's had the result of people paying attention to driving cash flow improvement.
Great. Now, it sounds like the business spans much of the globe, right? So are there particular countries or regions that perform better than others at this point that you noticed?
Yeah, it's interesting. I mean, our paper business, which is it's domestic U.S., is a really solid business and performs consistently well. There's some cost issues that can shift around on profitability in that for something called old corrugated container, which essentially is all of those boxes being delivered to your household from Amazon or wherever, getting into the recycling stream. To the extent the supply and demand out of that can get out of whack, it can drive cost somewhat and catch you sometimes. But from a geography standpoint, very interesting. One of our top performing markets in the world is actually Russia. It has been consistently good for us. And we generally do, our largest steel drum market is actually EMEA. And it's roughly twice the size in units as the U.S. And the U.S. is about the same size as our Asia Pacific, primarily China business. So from a profitability standpoint, Europe is a very strong performer in the GIP business. APAC, while not as high on gross margin, they manage their SG&A very well, and so they have a nice margin, and it's growing extremely well right now because sort of they've been maybe out of the pandemic, at least to a great degree, way sooner than everybody else. But yeah, strong performance in North America consistently. EMEA is always a strong performer, and APAC is now well managed. Latin America has been improving. It's not as strong as it used to be, and some of our Middle East businesses are very good. Some of our business in Africa, we've actually shut down a good bit of that. South Africa's an okay performer right now. So that's sort of around the globe.
Great, thank you. Now, Larry, you did touch on this earlier in your presentation, but I think this is always a very imperative question lately because we've been in the pandemic. So again, if you can elaborate for us a little bit on, has COVID impacted Greif, and what do you see as these long-term implications could possibly be from COVID?
Yeah, we were impacted actually in multiple ways. One, I indicated we never shut down. We'd have if we'd have somebody at a plant who was indicated as having contracted the virus or even seemed to by a fever or whatever, we would shut down a shift, disinfect the plant. We tried to put priority there. So we had some impact from that. The biggest impact, though, was in North America in the period of May through July of last year, where we had a decrease in demand because of all the shutdowns that occurred. That was offset somewhat because we saw increased demand for our steel drums for disinfectants. And so the overall impact, for us, we estimated last year to be about $120 million to us broadly across the globe. And we're now seeing nice recovery across all things. And what we also think is a positive for us is we don't think demand for disinfectants is going to decrease dramatically, particularly as you have reopening of restaurants and retail and all the other spaces that are going to need use of disinfectants. I think all of us will become more inclined to use them on an ongoing basis. And also, e-commerce has driven bigger demand in our paper business. And we think that people have gotten more used to the convenience. People who were reticent to use e-commerce before have, I think, now learned to enjoy it and the convenience. So we think those are the impacts out of COVID.
Great. Yeah, and I couldn't agree with you anymore on the disinfectant, I think, and hope that we all continue to utilize that a bit more moving forward. So Larry, next question. Who would you say your primary competitors are, and how does your business differ from theirs?
Yeah, very good question. So we have two primary competitors in our GIP business. And those, as a company, and they're both private. One is owned by a private equity firm that a guy named Mike Milken runs. You might remember Michael from Drexel Bernhard days back in the 80s. But they compete with us on steel drums, plastic drums, fiber drums, and IBCs. They are the number one in the world in plastic drums, and we're a very close second. They're number two to us in steel drums, but a pretty distant second. They are number two in rigid industrial bulk containers, and we're number three, and we're growing rapidly. They do not have flexible industrial bulk containers, which I had failed to message about on our slide. So that gives us a bit of a strategic advantage. They do not play in the paper space at all. Schutz is the number three player in that industry, significantly smaller, but they are number one in the rigid IBCs. They're number three in steel, a distant third, and they're number three in plastic, also behind Mauser, and they don't play in the paper space. They're good competitors, most of the time rational in the marketplace, but their focus is different than ours. They don't have the same focus on customer service that we do, but they're good competitors. In the paper business, in the corrugated space, we are a small player. We're a 2 to 2.5% player. We're a niche player. We play into specialty products, and we have some unique services in what is called converting, where we actually make what ultimately becomes the boxes. We'll take the brown paper that we produce in our mill system, make the fluting stuff that's in the middle called medium, put it together to make a box sheet, and we'll do that for box makers. We don't have box plants. And what our niche is we will do like 600 different orders a day. Most people in that business will do 6 to 10. They'd rather run long runs. We run lots of runs, and we do a lot of specialty components like high gloss and that kind of thing. Like I said, we're a 2%, 2.5% player, but in a nice niche. The big guys are Packaging Corporation of America, International Paper, Georgia Pacific, and WestRock. They are both suppliers and customers of ours. We do a lot of work with each of them. Then in our tube and core business, the two leading companies in the U.S. Are us and Sonoco. Sonoco is slightly larger than us, but between us, we have about 80% market share in that business as well. So very nice acquisition for us, and a very structured market.
Yes, definitely. And Larry, from what I've learned in this industry is that transparency is very important to investors. So how do you communicate with your owners and how do they reach you?
Yeah, Matt does a fabulous job of really making sure that we are accessible to our investors. And some people have told us we maybe go overboard in terms of our disclosure. We share a lot of information in our quarterly investor calls, and then we try to meet with whatever investors want. I spend a lot of time in it. Pete, our CEO, does as well. We view investors as another one of our customers, so we just try to be accessible and be transparent.
Great. And a couple more questions, Larry. We're almost wrapping up here, it seems like. What are Greif's growth priorities?
Yeah, good question. Our focus on growth is, to focus on expanding our business in plastic, drums, and primarily in rigid industrial bulk containers, which you might see on that picture we showed, like a big milk jug inside a steel cage. And it's more efficient for customers in many businesses as long as their customer can receive it in that form. But it's also highly efficiently reused and recycled. And we're the number 3 player there, but we have a lot of our customers around the world asking us to get bigger in that business. And so we've been on a path of expanding that business as we have committed volumes from customers. So we won't invest in a new line unless we have 50% of the volume already committed. But we've been growing that business rapidly. Of recent, our growth statistics in that business are over 30% year over year. So we'll continue to focus on growing the IBC business, the plastic drum business, and then in our paper business, what we want to do is get what's called over-integrated in that business. You make money in your mill systems. So what you want to do is make sure that you have some place to sell the paper. And that means downstream plants. Now, the PCAs, International Paper, WestRock, and Georgia Pacific, what they've done to do that is they've bought up like box plants and things in the country so that they know that they can run their mills and then have it go to box plant. As I said, we don't have box plants. We have converting facilities where we're sort of the middleman, and we serve both the large integrateds and also the independent box maker market that has not been bought up, and they tend to be fiercely independent. And we have great relationships with them. So what we will do is continue to invest in additional converting facilities. We did one a couple of years ago in eastern Pennsylvania. That got us to a level of 82% integration, which means out of every ton of paper that we produce in our corrugated system, we can use 82% of it in our own facilities. We would like to get over-integrated so that we have the choice to either place the paper in our facilities or sell it in the open market, which would ever drive the higher profit margin. So those are the places you'd see us as our highest priority for growth. And then the last would be, once we do get down into the 2 to 2.5 times, we'll explore potential acquisitions again. But that would be in those spaces or something very near to what we currently do.
Great. And Larry, I'm going to leave with the last question here. What are you most excited about?
What I'm really excited about, we're just really starting to see the benefits of all the work that we put in the last. 4 or 5 years, we had a transformation process where we looked at every plant in the world in detail and came up with a plan for every one. And we're just starting to see sort of the flywheel effect of, we've gotten rid of the poor operators. It doesn't mean that we don't have a few plants around the world where we're still trying to work on things, but we're really excited about what we're starting to see in terms of just efficiency of operations and what that means for cash flow generation. And the nice thing is, as we generate cash and pay down the debt, and I'm sure most of you on this phone understand this, but your enterprise value is what your enterprise value is. It's a combination of your equity value plus your indebtedness. Well, as we pay down the debt, all of that value shifts to the equity holders. So here we are paying a very nice dividend yield, and yet our stock price is going to go up very nicely in the next couple of years and hopefully beyond. And since I'm a relatively major shareholder, I'm really happy about that because I've invested a lot of my own capital in it. So we're excited about it. We like the path. We think we know we're a good company in terms of ethics. We believe we're a good company in how we're run, and we're excited about that.
Larry, thank you so much for this high-level overview of Greif. We do have some direct contact us information up on the screen right now, but my name is Lindsay with Family Office Networks, and I'll be following up with everyone individually as well to see if there's any additional questions or information we can get you. Larry, again, thank you for joining us today. I hope everyone has a great day.
Yeah, thank you. Thank you, everybody.
Bye-bye.